I'm Charlotte McLeod with investingnews.com, and here today with me is Clem Chambers, CEO of anewfn.com. Thank you so much for being here. Great to have you.
Great to be on.
Really good to be speaking with you. I think it's going to be a fun conversation. I was thinking, just because it's our first time talking, I wondered if you could start with a little bit of introduction to yourself and your work right now. I'm sure many people in our audience are familiar, but I think it's a nice place to start.
Well, I've been writing finance material since like 1999, when I used to write the money section for Wired magazine for a couple of years. And then money wasn't so wired when the dot-com crash came along and they killed that page. But anyway, I then started writing for Forbes, and I've written for Forbes for them now so long my contract is in Latin. And I still write for them. I write for people like Seeking Alpha. I've got my own channel on YouTube, which I just started just for the pure hell of it, which is called Clem Chambers Alpha. And I've been working with financial private investor communities. Investors Hub in the US would be the one that your viewers will probably know for 20 years. And now I'm setting up a website called A New FN, which will be coming to a browser near you actually sometime in September. And, we plan to do something new and kind of funky with financial information. And hopefully it will prove that we'll be able to offer a platform where investors, and for that matter, traders, have a chance at making some money. Because we all know that it's very tough to make money in the markets as a private investor, and not many actually do make decent profits. But I try to help people, and have over the last 30 years, get the best of the market and build up their own financial resources. And right now, which is why you've got me on, I've been singing about gold for about 6 months, and it's all come to pass. It's I might be lucky, I might be right, I might be lucky and right. But precious metals is something that's particularly interesting right now for me.
Well, very good. Thank you for going into that. We'll include some links in the video description so people can find you online. And yes, today we are here to talk about what's going on in gold and precious metals. So let's jump right into that. We're coming off a pretty historic week for gold, and maybe heading into another historic week. We'll find out soon, I'm sure. But I wanted to get your take on what's going on with the gold price. I've heard you say elsewhere that gold is for war. So when you look at this current price increase that we're seeing for gold, is that the main driver that you see, or how are you looking at it?
Yeah, absolutely. And, if you think about gold, the old trope is that gold is money, and gold's going to be money again, and money's going to be backed by gold, and, gold's the only true money, it's God's money, and blah, blah, blah. But, no, that's not why governments keep gold. Governments keep gold because it's the currency of war. So when you had a period of dropping global tension, and when the world was meant to be unipolar, and America was, the king of the pile, and everybody bowed down, and there wasn't going to be much fighting. It was all going to be police actions, no more war. Countries sold down their gold because they didn't need it. I mean, you don't need gold if you're not worried about fighting a war. It's the currency of war. However, if things start to get spicy, if stress goes up, well, a country has to buy it, has to lay it in. It's a strategic reserve in case of the worst. And that's why countries own it. And that's why they're buying it now. So in the past, where Wall Street and other financial institutions could push private investors around, because private investors bought gold and they controlled the market, so they could shake them out and, keep the price down and short it and do whatever they wanted to do to reap the rewards of being in control of the market. Well, those days are gone now, because it's governments buying. And, you just have to go look up Poland, holding the finance minister holding up gold bars saying, we've got more gold. Well, why would Poland want more gold? Well, the obvious answer is gold is for war, right? And of course, America's come out and said it's got a major problem with China. And guess who's buying lots and lots of gold? I mean, they make enough and then they're buying it. It's China. Because China has to build up its gold reserve, and, Europe has to build up its gold reserve. Everybody has to build up their gold reserve, because the road that all these countries are on are is the road of increasing global stress. And for a strategic reserve, I mean, like, you should be laying in petroleum, shouldn't you? You should be laying in strategic and critical minerals. Funny enough, America is. But you also have to lay in gold. And there's only 3,200 tons of it made every year. So now the 800-pound gorillas are buying it, i.e. governments. Well, Wall Street has to get out of the way of the price, and the price is only going to go one way. And the thing is, it's not just going up. It's going up in real terms. Now, obviously, people think of gold as an inflation hedge, which it is. But gold doesn't necessarily run, we've got 5% inflation this year, gold goes up 5%. It lags, it catches up, it runs ahead, it falls behind. But, when countries say, we need another 500 tons of gold in our warehouses, well, it pushes the real value of gold up. So gold outperforms inflation. And that's what you're seeing now. Countries like China, like Poland, like I think pretty much everybody really, if you could track the gold around, is laying in gold. Because if you're fighting a war and you want to buy, tungsten, you have to pay with gold. I mean, I use tungsten as an example because during the Second World War, it's a fascinating story, but the Nazis were buying tungsten off the Portuguese, who were also a fascist state at the time. They were buying tungsten for armoured piercing shells off Portugal in British £5 notes. And after a time, the Portuguese said, where are you getting these British £5 notes from? And the answer was the Germans were printing them. So guess what? The Germans had to end up paying for their tungsten with not fake British £5 notes. For that matter, not for their government bonds, not for their own paper notes either. They had to pay with gold because your paper's no good when you're fighting a war. And as you move towards that terrible moment, doesn't mean you have to get there. But as tension rises, if you've got any sort of sense, if you've got any sort of strategy, you have to lay in more resources just in case there is a conflict. And that means buying gold.
Well, and it does definitely feel like tensions are heating up around the world. So that makes a lot of sense as the top driver for gold right now. I want to ask you a little bit more about that inflation angle, because I think everybody right now is quite focused on interest rates in the US as well, looking toward that Fed meeting and thinking that rates are going to come down. But I know there's also concern that if rates come down, then maybe inflation is unleashed again because it's not quite under control. So how are you seeing that? How are you seeing those dynamics play out?
Well, I'm a little bit contrarian, and people are going to say, what's he talking about? Printing money causes inflation. Okay, there's only one set of people that can create inflation, and that's government. Okay, they can create deflation if they want, like Japan has done for many, many years. They can create inflation if they want. Simplest thing in the world to do. They generate inflation if they want it. If they don't want it, they don't have to have it. Now, printing money doesn't necessarily create inflation. In the old days, everybody would say it does. It depends what kind of money you print. Now, most people think money is cash. And when someone says, we're going to have a digital dollar. Well, dollar is digital. Most dollars are digital. Most dollars are held on hard drives that go spin, not dollar bills in your pocket. Most dollars are not even dollars, really. They're just book entries. Now, if you print money, and not literally on paper, but if you print it digitally, as most currency is, it depends where you put it. Now, if you inject it into places where people are going to hold it, it's not so inflationary. If you give it to the rich, it's not so inflationary. If you give it to the poor, it's very inflationary, which is what the inflation from COVID was mainly caused by, because it was injected at the level of people that not only enjoy spending their cash, but also have to. Now, if you give rich people cash, what am I going to do with this? I got all the money I want. I got all the money I need. Well, I think I'll spend it on rich people's assets. I'll spend it on real estate. Up goes real estate. So you get real estate inflation. Or I think I'll put it in stocks. Up goes Nvidia. Yeah, and that money is locked up in those assets. It doesn't drop immediately down into the group of people that will take it down the supermarket and push up the price of tomatoes or beer. I mean, back in the day of COVID, it was funny. I was actually in France, and they, handed out money to people like most countries did to everybody to keep the wheels turning. And immediately all the hard liquor disappeared off the supermarket shelves because everybody traded up to hard liquor from beer and wine. And that's the example of what happens when money is injected to people that are not well off. So in the modern world, you if you want to print money, you inject it via QE and it goes into rich people's assets. And that's where you get the inflation. And then it trickles down and everyone complains that they don't get it. And they complain that rich people get it, et cetera, et cetera, et cetera. But the money goes in, the economy spins up faster, assets inflate, but the price of beer doesn't. So when they drop interest rates, they're going to have to QE because everyone's going to say, I don't want your crummy bonds. You're dropping interest rates. Why would I buy those? So they're going to say, well, we'll buy them ourselves then, won't we? And they will QE. That's what QE is. Basically, it's a way kind of monetizing government debt. Now, that's strictly taboo to monetize government debt. You're not allowed to do that. But you're only doing that if you're turning it directly into dollar bills. Now, if you turn that into assets that are not so liquid. So this is the idea. Money has different levels of liquidity. If I give you a $20 bill, it's very liquid. You go and you can spend it. If you put that with your bank overnight, well, it's not so liquid. It takes a day to get it. If you put it into a treasury bond, well, it's not liquid at all. It could be liquid. You could ring up your broker and he could give you cash in 2 days, but you're not going to because you've invested it and you've invested it to get the coupon on it. And if you take that cash and you put it into Nvidia, it's even less liquid because you don't really want to sell it. And then if you put it into a house, it's not liquid at all because it takes you 90 days to sell it. So that money, depending on where it goes, depends on how combustible it is and how inflationary it is. And central banks have got the knack in the West anyway of printing money and pushing it into places where the cash is not liquid. Now, if you're in South America, you print money and you pay the wages with it. Boom, it immediately creates inflation. And that's why when South America prints money, they print money and it creates inflation, and it means they don't have to tax their people because that's difficult. Their people run away or pretend they haven't got any money or just don't fill in the form. Yeah. So in developing countries, they don't have the ability to knock on your door and say, give me taxed. So instead, they tax everybody by just printing money, and that devalues everybody's money. And it has all sorts of negative effects. But it's one way of actually taxing people. So, inflation is a tax. It's a way of governments get out of debt, and it's a way of juicing the economy. Now, obviously, I'm a politician. I want to get elected. I want interest rates down. I want to print money. I'll blame the inflation on someone else, and I'll get elected. So you have a central bank that's independent. So when I go, hello, central bank, print some money for me, the central bank says, no, that's bad. Oh, no, well, we need to. No, it's bad. We're not going to do that. Well, drop interest rates for you. No, we're not going to do that. That'll be bad. Well, okay, you're not independent anymore and you're going to do it. And my mate is now the central bank boss, and he'll do it. Oh, hello, friend, print some money for you. Oh, you will. Oh, I've got some inflation. No, it's someone else's fault. Oh, I got elected. So the reason central banks are independent is to stop politicians bullying their mates in the central bank to print money to create inflation to get them elected. Does that ring any bells?
Yes, it sure does. Yes.
So we're going to get elevated inflation. We're going to get QE. We're going to get falling interest rates, and any hard assets are going to appreciate. In addition to the ones that are going to appreciate like gold because of the ugly increase in geopolitical tension that we're seeing. So good markets, unless somebody does something to crash the market. And even then, if it does crash, they've got that lever to pull to make the market go back up again. So assets protected, juiced, but you will get elevated inflation. Inflation is not real inflation. The inflation you feel in your pocket is not going down. And, that is because they're just going to be printing money to get interest rates down.
I think that gives a very good idea of how you see it. And you started to talk a little bit about the stock market, and maybe we can go a little bit more in that direction, because I see a lot of questions from investors about what's going to happen there. Are we going to have a crash at some point? It's kind of continued to go. What do you see coming?
Well, of course we're going to get a crash. The market always crashes. We've had one this year already. The question is, does that crash create a domino effect that then blows into the wider economy and has a negative systemic impact? And I think the answer to that is no, because, the central bankers, and whether they'll stay independent or not, they do know how to stop a stock market crash. And when they do that, obviously it has inflationary impacts because they have to print money for it. So what actually happens is when the Treasury or the Fed puts money in, all the investment banks are watching. They literally can watch the printing presses. So when, say, Jay Powell says, right, I think we need to set the printing press going, or the equivalent, and, the banks actually hear the printing press go, and they go, whoa, okay, buy, because they can see the money coming. They literally see the flow past their desks. So when the government says, yeah, I think we need a bit of support here, they push money into the economy, which goes to them. Yeah. And they can get a little bit more return from this free money they're getting. So they're paid to buy stocks and take the risk. Okay. So every time bad things happen, as long as the politicians or the central bankers or whoever it is, considers that a crash will be bad, or it's gone down enough, or it shouldn't go down anymore, they just press that button and the money gushes out the front door of either the Treasury or the Fed. And then the banks are there with their binoculars going, right, the money's coming, buy. Then up it goes. So that's how it works. That's how the market is manipulated, for want of a better way. Now, in the old days, it'll go down and everybody in the Treasury will be going, oh, well, markets do their thing. And the Fed will go, oh, markets do their thing. Oh, this is not good. Oh, this is getting a bit minty. Oh, no, all these people are going bust and they've gone bust and no, it's terrible. Oh, what are we going to do? I don't know. It's all too late. They don't do it like that anymore. Really, 2008 was the first time when it really was on the precipice in 2008. The whole global economy and Americans' economy was on a knife edge of absolute meltdown. And they went, right, no, there's this new theory of money, and there's this thing called QE, and it's in textbooks and no one's tried it, and we're told it's a lot of old rubbish, but if we don't do it, it's all over. So pull that lever, TARP, and all that thing happened, QE happened, and it worked. And everyone said, oh, it's going to be inflation now. Oh, no, hyperinflation. Oh, no. Oh, it hasn't happened. Why didn't it happen? What? Oh, theory worked. Oh. And most people still don't understand it because they push the money into illiquid assets or low liquidity assets. Real estate, low liquidity asset. Equities, buy and hold, buy the dip. Low liquidity assets. So the money went to the rich because they don't need it. They don't need to spend it. They got enough of it. So the money goes into the system. And where do the rich put their money? They don't put it under the bed. They give it to the banks. And what do the banks do? They lend it out. And the companies that are going bust because they can't borrow money, they can borrow it. So they borrow it and they don't go bust and you keep your job and, the world goes ever on. And, and the trickle down happens and and everybody's grumpy because they didn't get the money. Someone else got it. But nonetheless, that's how the system works. And of course it works and it works and it works and things go up and things get better and better and better until they blow up. But I think we're some way away from that happening because I don't think many people understand the new cycle. They just see it happening and go, oh, I don't understand. Why am I getting some of that? That's not fair. But actually, it keeps the wheels on. So we could have had a crash. Well, we did have a crash. And they used the modern economic manipulative tools to stop that crash. So we didn't have a meltdown. We didn't have a stock market implosion. People didn't lose their pensions. They didn't lose their 401ks. They didn't end up, buddy, can you spare me a dime? Yeah, because they know how to, they jump in front of that now and they preempt it and they fix it. But of course, there's always a cost. And that cost is often and will be inflation. And it won't be runaway, but it will be elevated. So if you realize inflation is going to be elevated and you realize what they're doing, you can, make the most of it. Interest rates are going to go down. So maybe if you can get a high return, you want to borrow money to get a high return, all that good stuff. All that good stuff that if you know what's going on, you can take advantage of. And if you don't know what's going on, you can't take advantage of it. And you're in that minority that's going, what happened? Why am I making money? What's going on? Why are these people driving purple Lambos and I'm not? So it's all about unpacking all this stuff. And we're in a elevated inflationary situation. QE is coming. Interest rates are coming down. The dollar's going to fall hard. And precious metals are going to go up.
That lays it out very well. And in terms of cycles, talking about cycles, where would you place gold in the current cycle? What would be your outlook on the price? We mentioned we're at all-time highs right now. Where do we go from here?
Well, I'm not a fan of all-time highs because I'm a contrarian investor. That's my DNA. So, I buy when nobody wants it and I sell when people start wanting it. That's my normal instinct. And of course, all-time highs, I want to sell because it's an all-time high. Everybody likes it. But over the years, I've learned to kind of grimly hang on to stuff that's going to continue to run. And, technical analysis, people either love it or they hate it, but it's an incredibly, incredibly bullish chart. And it says to me somewhere over 4,000, 4,500. But it's only showing you what's happening under the hood that you're not allowed to look at. Yeah, if you are in the Pentagon and you're going home, and you're saying to your spouse, "Oh, blimey, you never guess what's going." Oh no. And she's going down that hair parlor and says, "Oh, and it all trickles out, doesn't it? If you're sat there watching satellites and whatever's going on underneath your camera, that's the information flow. And before it gets into the newspapers, it gets into the chart of the asset. And, you're just seeing what's going on. But the big picture is gold is for war. And as we seem to be, hobbling down that road to catastrophe, the price of gold is going to go up. Now, obviously, sanity will break out, hopefully, and we won't all end up in the Holocaust. And gold will be a lot higher as we approached those sort of things. But, I don't know what the price of gold is at 1 minute to midnight. And I always thought 5,000 would be, a very, very, very bad sign. But it looks like it's going to head towards that pretty quick. So I don't know. As I say, it'll be in the chart before it's in the news. So my actual model does give a little bit of advance warning. Bitcoin is for flight. Okay, so before the proverbial hits the fan, crypto will go ape. And if crypto doesn't go ape, people aren't thinking about running away. And of course, when things get really spicy, people start thinking about running away, getting their family safe, getting their money safe. And the rich are the ones doing that. And they will, if they haven't got their money out, and, quite often you can't, they will be running to crypto for that, because crypto is the way that you can encapsulate, I believe that's the old-fashioned word for it, with, 100 million or 200 million or 500 million. And those people are out there. And they will use crypto to do that at short notice. So at short notice, and before it's in the news, you will see crypto go up like that. And you saw that when they bombed Iran. You saw that when Afghanistan did its thing. And, the minister had to leave his $5 million on the tarmac because he couldn't get it in the helicopter. Yeah. Every time somebody's going, "Oh, no, I think I might have to leave." If it gets really unpleasant in Ukraine, you'll see it in crypto. Suddenly crypto, for no apparent reason, go. And then if it isn't going to happen, it'll go back down again. And then gold will go trudge. So crypto's your advance warning for really bad developments or just local bad developments. So, if the Houthis are going to sink some super tankers next week, you'll see Bitcoin do that. Yeah, because everybody knows, but we don't. And the first thing it will move is in Bitcoin. And then if it doesn't happen, it'll go back down again. But the Bitcoin is the canary in the coal mine. Gold is basically the horde, the dust cloud of the horsemen of the apocalypse coming over the hill. Yeah. So the two together give you a pretty good steer. And, you know, I'm very much positioned in precious metals because there's another very important theme, which is completely separate. And that's AI. AI is going to boil the oceans, absolutely boil the oceans. They're already building, you know, service centers as big as Manhattan. And, you know, it's going to boil the oceans. And for that, you need strategic and critical minerals because, you know, it's cables and it's cooling and it's electricity and it's making electricity and making energy and pollution and all that stuff. And that all comes back to the periodic table. So things like platinum, another precious metal, palladium, another precious metal, copper are going to be in great demand. And, you know, you can read it right now. You go, is there going to be a shortage of copper in the coming years? And it'll say, yes, there's a shortage of copper in the coming year. But it's going to be way, 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 way more than they predict. I was talking to some energy people only on the weekend, and I said, so there's going to be a lot more need for energy, isn't there? And they said, yes, it's going to be at least double. I said, it's not double, is it? And they looked at me because, you know, not really allowed to say how much energy is going to be needed because that's got all this environmental stuff attached to it, which is a big deal. You don't want to go around saying, oh, we're going to need twice as much energy in the next 5 years, because the implications of that are pretty drastic. And he said, well, I suppose we're going to need double. I said, it's going to be 10x, isn't it? Mm-hmm. Yeah, it's going to be 10x. They're going to, you know, there's going to be absolutely no cap on the demand for energy because of AI, because AI is pure energy. Yeah. And there's no second place in AI. If you haven't got as much AI as your global competitor, you're toast. If America doesn't have as much as China, America's toast. And if China doesn't have as much as America, China's toast. And if Europe doesn't have as much as America, Europe's toast. And there's no limit to how much you want. So there's no limit to how much energy you need, you must have. And of course, it's not what energy that we want, we need. It's the energy that governments need to be relevant in the world. Well, that's gone infinite now. So they're going to need infinite energy. They're going to need infinite copper. They're going to need infinite platinum, palladium to break down all the pollution that's going to cause. Yeah. So that's another fork. And that's probably going to work out brilliantly for everybody. That's going to work out economic boom and prosperity and, you know, everything you could possibly imagine, from a materialistic point of view. Yeah. But that is another pathway we're going on. So one pathway we're heading towards global conflict, and another pathway we're heading towards massive global economic boom. And, you know, one of them is escapable because, you know, the idiots that rule us can actually, you know, stop reading the history books and wanting to be in them and start wanting to look after us. They can, you know, the sanity can break out. But the AI thing is going to absolutely 10x everything, absolutely everything, because it is the Industrial Revolution. The Industrial Revolution was, you know, artificial muscle. Well, this is artificial brain. And that there is no natural limit for the creation and use of resources because of that. And it's not futurism, it's here now. And they're building that stuff. Oh, 600 billion here, says Mr. Zuckerberg. You know, and it's all energy consuming stuff. So they have to make the energy to get it consumed. And then you've got this vast output of energy that's going to go into industry, and you know, it's just going to be absolutely explosive economic situation over the next 10 years, and huge sums of money to be made.
So I want to ask a little bit about silver as well. So we've got gold for war, we've got Bitcoin for flight. What is silver for? Do you have a word for that one as well?
Well, I just say that silver is retail gold. Yeah, I mean, I used to be a professional numismaticist. Can you believe that? So I used to be, you know, part of the collectible coin world. And if you look at coins, there's three. Well, there was actually four, but let's not go back to the Bronze Age. You've got three currencies: gold, silver, copper. Gold is for cashes and I don't mean cash. I mean in a pot. You dig a hole in the corner of your house, put your gold in a pot, put it in the corner so you can come back if your house burns down and find it, and then you cover it up and you cash your gold. It's you bank it effectively, whether you bank it in your house or you bank it with a goldsmith. It is only for a store of wealth and for the biggest of transactions. So you don't walk around with it. I mean, you might have to if you're going a long way and you're not coming back for a long time. You might have it on you, but generally, gold is for storage of wealth. Silver is for big transactions, biggest transactions. You wouldn't buy a house with silver, but you buy a horse. Yeah, or you would buy a hotel room with a tiny little coin. You'd maybe get a night out or a meal. So it was for medium-sized transactions. $100 bills effectively is silver, and that's in a purse. So you have that hung in a special device to stop you losing it. And then you've got copper, and copper is for your pocket. It's pocket money, and that's why you find a lot of copper, because it falls out of people's pockets. Still the same today. Yeah, so you've got those that hierarchy of money. Well, normal people, silver is more accessible. And for those of us out there who are worrying about the end of the world and Mad Max, silver is what you would buy if you want to buy a ticket or you want to buy a chicken, a silver coin. Gold coin's too heavy. Yeah, it's got too much value in it. So silver is the retail gold. It's the practical precious metal for the masses. And that's what it's always been. Governments, and I always tell this story, and if you've seen me before, guys and girls out there, I apologize for you hearing this again. But when America retreated from the Philippines, they put the gold on a battleship. It might have actually been a submarine, but let's say a battleship. And they took the silver from the Philippines and reserve and bank, and they threw the silver in the bay. They literally took all the silver, chucked it in Manila Bay, because they couldn't take it with them. There's too much of it. Yeah. So they took the gold, dumped the silver in the bay. The Japanese got American prisoners to dive down and pull it out again. But, that is the difference. Gold is for war. Silver is the retail sister. But of course, retail, when it engages, is a juggernaut. In the same way as government is a juggernaut when it engages, it's, the private sector and the public sector are basically equally balanced. So if all of a sudden the retail world goes, oh, I think I need to put some of my paper into a metal, they would head for gold, but they also head for silver. And of course, if silver's going up, they head for that because they think that it's going up. They're early to the party. So you get that effect, that FOMO effect, and you are seeing silver having that FOMO effect right now. And there's no reason it wouldn't go to $50 an ounce or $100 an ounce. And of course, when you get a FOMO event, you can't predict the top because it goes boom, bubble, and then of course bust. But, we're in a period where silver is going into that phase of boom. And it's the fast horse. When it goes, it goes. It's gold tends to go grind. Oh, I'm going to go sideways for 3 years now or 4 years. Oh, grind. Silver tends to go, nobody loves me. Bang. Oh, bang. And we're kind of in that repricing event now. Now, the thing that I say, and please, people, this is not even an opinion. It's just a statement of fact. There's 3,200 tons of gold mined every year. Okay, so that's quite a lot of money. There's 25,000 tons of silver. Well, that's only 8 times as much silver than there is mined gold. And gold ain't 8 to 1. It's 80 to 1. Now, it's not going to be 8 to 1. It wasn't even 8 to 1 back in the Roman period. It was like 10 to 1. So, that's probably not going to happen. But it gives you an idea of the supply. Although there are other issues with silver, being that there's, hundreds of years of people making silver teapots and silver plates and silver knives and forks. So there's a big well of reclaimable, recyclable silver out there. Should the price go much higher than it is now, they will be turning, beautiful ancient Victorian and Georgian and 300-year-old teapots. They'll be melting them down for ingots. Because, nobody wants the silver teapot anymore, but nobody wants to melt them down because seems like sacrilege, doesn't it, to melt down a 300-year-old tea service. for the cash. But it will happen, and it happened back in the 80s. Everybody, went round and pulled out all their silver salvers with 200 ounces in them, and off they went to be melted down. But there's still a lot of that out there. So there is the city can be mined for silver. So that lack of supply is just indicative of an imbalance. Now, when you go to platinum and palladium, which are two of my favorites, they only mine 200 tons of that. 200 tons. That's like, and I always say that's like zero. And you need to go and check that number, because I keep checking it because I can't believe it. I still can't believe it after all these months of keep checking it. 200 tons. And it's in such short supply that America is buying it off Russia, even though there's all those sanctions out there. They are still buying it. It's not sanctioned because there's only three places that make it. North America, a little bit, South Africa, a little bit, and Russia, a little bit. And, it's vital for chemistry and for environmental remediation. And the way I see it, they're going to be burning everything. They're going to be burning your car for energy. They're going to be burning everything for energy. And making energy is going to need a lot of environmental remediation because it's going to generate pollution. Even America's saying they're going to start burning coal again. And coal is not even the cheapest energy source anymore. They're going to be going back to coal. Well, you're going to have to remediate that. If you're going to be generating 2 or 3 times the amount of energy, and they will, it's not down to me. I'm just telling you they're going to. I'm not suggesting they should. They're going to have to remediate that. And they're going to have to remediate that with catalysts like platinum and palladium. And they're going to use platinum and palladium on fuel cells for hydrogen, the hydrogen economy. Which needs platinum and palladium for all sorts of parts of that hydrogen economy idea. And they're going to be going gung-ho for that too, because they're going to be saying, how can we get energy? There's nuclear. Okay, we'll build all that. How much can we build? Yeah, build all that. And how are we going to get more energy? Oh, yeah, geothermal. Yeah, start drilling holes for that. Yeah. And how else can we get energy? Oh, coal. Yeah. Start digging it up. Yeah. How else? We're going to burn wood. Yeah, start chopping the trees down. What else? How else can we get it? Oh, hydrogen. Yeah, we need that too. Windmills. Yeah. Solar panels. Yeah. How else can we get energy? Oh, we can make dams. They are going to boil the ocean. And for that, they're going to need platinum and palladium to sort out some of the mess that will cause.
It all really starts to fit together when you talk about it. And I'm curious about how you're going about getting exposure to the precious metals. I'm thinking about how are you splitting it between each metal, and do you prefer physical? Are you interested in any of the mining stocks? How are you looking at it?
I don't like mining stocks because they don't track. And I don't like that. Up goes gold. What happened to the gold mines? They've gone down. What? What have you done? You've hedged all your gold. What you've been doing? You've been digging out all the low quality stuff now that the price is high, so you can keep the high quality stuff for when the price comes down. The mining companies get up to all sorts of monkey business. There's the old phrase that says, if you can't see the fool at the table, it's you. Yeah, and I always get that feeling when I'm meeting miners. So they're last on my list. And physicals are good, and there's places where you can get physical. Back in the day, I had quite a lot of crypto gold, but then I got uncomfortable with crypto as a whole, so I don't hold any precious metals tokenized. But there are people that can vault it for you, and that's good. And they're out there. You can just go to somebody like a Solomon Gold or a Kitco or a Bullion Vault. And I'm not sponsored by any of them, but they're good examples. And you send them the money and they say, we're holding it for you, or they post it to you. You can do that. I'm not a fan of posting it to me because, I don't want it under my bed. But I like it. I get physical gold and platinum and silver vaulted. In Switzerland, mainly, if you have the resources to make that worth your while. ETFs, I love ETFs. I don't really love them, but I mean, they are. It's there. The counterparty risk is lower, and the cost of doing business is lower, and they do track. And if you want to lever up on it, you can always lever up an ETF with your friendly broker. Not that I'm a fan of levering anything up, but you can lever up ETFs, and then you can go into the mines. And I have some mines, but I literally was trying to buy copper mines, and I could only find 2 that I would touch with a 10-foot barge pole. And that's a reflection. Do your due deal. Every time I do due deal on mining companies, I go, oh no. I want a mine that tracks the price of the metal roughly, doesn't lag too much or run ahead too much, and it's in America, and there's no stories, and it's been going grind for 10 years. It's hard to find those guys. It's hard. There's not much out there. But if you like to live dangerously, there's plenty of speculative mining companies, minnows and micro minutiaes out there that have got a mountain of this here, so they say, somewhere far away where you can't check it. And it goes from those tiny little speculative companies that will rip your face off, all the way up to the big guys. But I find the actual stocks themselves very, very difficult to get excited about. And the ones I do get excited about, they tend to get bought out before the real action starts. And that also makes me rather, I like ingots. Ingots are good, but you don't get the leverage. But if you want the leverage, you can, go to the ETFs and lever up on it, and you can deal in futures and stuff like that. But, that's a very specialist game, and I think that it's much better not to gamble, and it's much better to farm, better to stake than play games. And for that, ETFs are ideal for the average investor. There it is, whatever GLD or whatever it's called in your country, and you say, well, give me 50 grand of that, and they are, you've got it, and you can sell it like that, and you get paid like that, and the costs are low, and it tracks. That's the important thing. Does it track? And if it doesn't track, why did it go up today when the physicals went up? Why is that? I don't understand. So that's why I have trouble with the stocks. I mean, I've got very, very, very few stocks. I've got a platinum stock and I've got a copper stock. I haven't got any gold stocks. I cannot find one that I can feel like I can look in the eye and say, you're not playing games, are you?
Well, I think that makes a lot of sense. I understand the way you explained it there. And I think we've made it through a good number of topics today. So I'll let you go. But before I do, any final thoughts you would leave investors with right now?
I think that the best way to operate in a market like this is to get your theory in place. It doesn't matter how crazy it is. It doesn't matter, as long as someone else didn't tell you what it was. You worked it out yourself, and then you benchmark that about what happens. So when I'm not a gold bug. You see, I've been brought up, even as a child, I was surrounded by gold bugs, and I built up antibodies to all that stuff about the collapse in the dollar and all that. I hate that, and I've never really been. I just don't dabble in that end of town because of history. And then 2000, and then COVID came along and they started printing money, and I thought, whoa, gold is going to go 8. So I loaded up on lorries of it, and it didn't go 8 at all. Yeah, it didn't go up at all. And I thought, yeah, that'll teach you. And then suddenly I just realized what the devil it was for. And then when America comes out and tells Europe to get on with fighting the Russians because they're going to be fighting the Chinese, it's not really, that's the theory. And you go, oh, did they really say that? That can't be right. Oh, why are all the European military stocks going through the roof? Oh, they did say that. Oh, no, he said that. Oh, no. So you just benchmark your theory against what happens. And you go, oh, I must be wrong about that because it hasn't actually, that doesn't fit the model. So you build up your model by trial and error, and then you navigate using it. And if you do that and are diligent, you won't go far wrong. In fact, you'll do really well. And over time, you'll adapt your market model to one that's very useful. And that's the way that people should go. And they should use videos like this as raw material for their own thinking, not as the law. If you're 55% right in the market, you do very well. So a little bit better calling heads and tails than random, you'll do very well. And, if you're getting 60-40, you're doing really, really well. Financially, you're doing well, not that you're just being clever. You're doing financially well. So, you have to build up your own theories, your own speculations based on raw material from people like me. Just don't take what I say as correct. Check, just read it up on what I've said, and half of it will make sense and half of it will appear to be complete rubbish. And then you draw up your own conclusions, your own theory, and over time that theory will be profitable for you. Maybe you'll be 65% out of 100 right. And that will be, wonderful.
Well, I think that's great advice to end on. So thank you very much for that and for coming on to talk today. This was a lot of fun.
That's my pleasure. And I hope you'll invite me back so I can tell my crazy theories.
Oh, I would love to. We'll definitely have you back. For now, I'm Charlotte McLeod with investingnews.com, and this is Clem Chambers.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.